It does not arrive as breaking news. It does not come with a press conference or a warning letter from your bank. The mechanism that is quietly repositioning 500,000 Canadian mortgages toward the edge of default right now operates through a chain of events that began not in Ottawa, not in a Bay Street boardroom, but in Washington. It began the moment a trade policy decision made by a foreign government started flowing through supply chains, through factory floors, through layoff notices, and through the front doors of ordinary Canadian homes. You did not vote for it. You did not sign up for it. You had no mechanism to opt out of it. But if you hold a mortgage in Canada in March 2026, the tariff war is already inside your financial life whether you have noticed it yet or not. Welcome back to Canada Property Watch. And over the past several weeks, we have documented the internal machinery dismantling the Canadian housing market from within. We exposed the negative amortization trap, growing mortgage balances on 420,000 Canadian homes while borrowers paid faithfully every single month. We broke down the Bank of Canada's own research, revealing the 2-year countdown that precedes mortgage default, the credit card signals that banks are reading in real time while homeowners remain completely unaware. Today, we are connecting those stories to the largest external shock the Canadian financial system has faced since the 2008 global financial crisis. Today, we are documenting the tariff transmission mechanism, the precise sequence through which American trade policy becomes a Canadian mortgage default event. And we are drawing directly from the Bank of Canada's Financial Stability Report, from Statistics Canada employment data, and from mortgage arrears projections that the central bank published and that the mainstream media covered for exactly one news cycle before moving on. We are not moving on, because the data inside those reports is not historical. It is a live countdown that is running right now in every trade-exposed community in this country. To understand how a tariff becomes a foreclosure, we have to build the transmission chain step by step. It is not a straight line from Washington to your mortgage statement. It is a cascade. And like every cascade we have documented on this channel, it begins with something that looks manageable and ends somewhere that was completely unimaginable at the start. Let us follow that chain with precision. Step 1 is the sector shock. The Bank of Canada has identified that loans to households and businesses in trade-sensitive industries represent approximately 15% of assets held by Canadian banks. But the knock-on effects of an economic slowdown reach far beyond that 15%. They extend into every community and every income bracket connected to those industries through supply chains, through local services, and through the regional economies that depend on manufacturing employment as their foundation. The trade-sensitive sectors are not abstract categories on a spreadsheet. They are auto manufacturing in Windsor and Oshawa. They are steel fabrication in Hamilton. They are lumber operations across British Columbia. They are agricultural processing in Alberta and Saskatchewan. They are the manufacturing corridors of southern Ontario that employed hundreds of thousands of workers at wages high enough to qualify for the mortgages they signed in 2020 and 2021 when interest rates were at the lowest levels in recorded Canadian financial history. These are not marginal workers. These are the mortgage holding class. These are the households whose income was stress tested, whose files passed underwriting, whose payments were current every single month. They are the people who followed every rule the system gave them. Step 2 is the employment disruption. When tariffs on Canadian exports to the United States raise the cost of Canadian goods in the American market, American buyers source from domestic producers or from countries with preferential trade arrangements. Canadian production volumes fall. That Canadian employers reduce shifts, freeze hiring, and eventually begin issuing layoff notices. This is not theory. Statistics Canada employment data from the first quarter of 2026 shows job losses accelerating in manufacturing, construction, and resource extraction simultaneously. These are not the white-collar layoffs we documented previously on this channel. These are hourly workers, tradespeople, people whose household income is entirely dependent on the continuation of a single employer's production schedule. When that schedule changes, their income does not gradually decline. It stops. A shift worker does not receive a performance review and a severance package negotiation. They receive a message telling them the plant is moving to a reduced schedule effective immediately. Let us build the profile of a family in this position. But let us call them James and Patricia. James operates heavy equipment at an auto parts supplier in Cambridge, Ontario. Patricia works part-time at a dental clinic in the same city. Together, they brought home approximately $138,000 in 2023. In the spring of 2021, they bought a detached home in Kitchener for $875,000 at a 5-year fixed rate of 2.4%. Their monthly payment was $3,640. At the time of purchase, that represented 31.6% of their gross monthly income. The mortgage broker confirmed they were well within acceptable debt service ratios. The bank approved the file in 4 business days. They moved in that August feeling genuinely proud of what they had built. And by January 2026, the auto parts supplier where James works had lost 2 major contracts to American producers who were reshoring production to eliminate their own tariff exposure. The plant announced a reduction to a 3-day work week with immediate effect. James's take-home pay dropped from approximately $5,200 per month to $3,400. The household budget that was functioning on $138,000 per year is now running on the equivalent of $92,000. The mortgage payment did not change. It is still $3,640 per month. But the financial architecture underneath it collapsed in a single payroll cycle. There was no warning clause in the mortgage contract for this. There was no protection mechanism. The payment obligation is fixed. The income is not. This is the tariff transmission in its most direct and visible form. But there is a second transmission channel that is less visible and far more widespread. It operates through inflation. The tariffs on Canadian exports combined with retaliatory measures and the reconfiguration of global supply chains are adding costs across food production, energy, and manufactured consumer goods. These pressures operate like a stealth tax on every Canadian household simultaneously. Even households where employment remains stable and wages have technically kept pace with headline inflation are finding that essentials, groceries, fuel, insurance, utilities are consuming a measurably larger portion of each paycheck than they were 18 months ago. This channel does not require a layoff. It does not require any direct connection to a trade-sensitive industry. It operates on the family in Vancouver, whose income comes entirely from the service sector. It operates on the couple in Halifax, whose jobs are completely insulated from trade exposure. They are still paying more for the same groceries, more for the same fuel, more for the same manufactured goods that flow through supply chains disrupted by the tariff environment. Their mortgage payment is fixed. Their purchasing power is being eroded from every direction simultaneously, and the erosion is not reversing. For James and Patricia, the 2 channels are converging at the same moment. The income reduction from the work week cut, combined with the inflation-driven increase in essential spending, has created a monthly gap that their household budget cannot bridge through any conventional adjustment. And they are now in the early phase of the pattern that the Bank of Canada documented across 9 million Canadian credit files. The credit card balance that was 0 in 2022 is carrying $4,200 today. The utilization rate on their line of credit has moved from 12% to 41% in 6 months. They have not missed a mortgage payment. They are protecting it above every other financial obligation. But the signals the bank's algorithm is reading from their credit profile are identical to the pattern the central bank's own researchers identified as the 2-year countdown to default. Step 3 is where the tariff shock transitions from a household income problem into a systemic housing market event. The Bank of Canada has stated directly in its most recent financial stability communications that in the near term, the unpredictability of American trade policy could cause further market volatility and strains on liquidity. The bank warned explicitly that continued trade policy uncertainty could lead to acute and persistent liquidity pressures that test the financial system's resilience. When the Bank of Canada uses the word liquidity in the context of the housing market, it is referring to the ability of the mortgage system to continue functioning normally, to continue approving renewals, extending credit lines, and processing property transactions at current valuations. When liquidity tightens, the first visible consequence consequence is that property valuations begin to reflect the uncertainty. The banks become measurably more conservative in their appraisals. The comparable sales that underpin every property valuation in Canada begin to reflect a market where qualified buyers are hesitant and motivated sellers are increasingly willing to accept whatever they can get. For James and Patricia, this creates a compounding trap. Their income has dropped, their credit utilization has risen, and the equity buffer they thought they had accumulated in their Kitchener home is now uncertain. The home they paid $875,000 for in 2021 may have been worth $920,000 at the peak in 2023. But comparable sales in their neighborhood in early 2026 are documenting a different reality. The same floor plan 2 streets over sat on the market for 94 days before selling at $761,000. That single transaction has reset the comparable value for the entire area. Their HELOC, which they believed represented $80,000 in available emergency credit, has not been formally frozen. But when James calls the bank to inquire about drawing on it, the representative informs him that the bank is conducting a portfolio reassessment and that his file is currently under review. The Bank of Canada's own stress scenario has identified that if tariffs remain in place for an extended period, mortgage arrears in Canada could reach levels not seen in a generation, potentially exceeding the arrears rate recorded during the 2008 to 2009 global financial crisis. That context requires a moment of reflection. During the 2008 financial crisis, Canada was held up internationally as a model of mortgage market stability, and our arrears rate barely moved compared to the catastrophic default wave that swept through the American housing market and triggered a global recession. For the Bank of Canada to project that the current tariff and renewal combination could produce an outcome worse than 2008 by our own historical standards is not a routine forecast adjustment. It is a statement that the convergence of external trade shock, domestic renewal wave, consumer credit stress, and inflation-driven purchasing power erosion represents a more dangerous combination than the conditions that preceded the worst financial crisis of the modern era. Step 4 is the renewal collision, and it is the moment where every other element of the cascade becomes irreversible for the individual household. James and Patricia have a 5-year fixed mortgage signed in 2021. Their renewal date arrives in the spring of 2026. They are approaching that date with reduced household income, elevated credit card and line of credit balances, and a property that has declined in estimated market value since their purchase. The bank's renewal offer reflects the totality of the current environment. The new 5-year fixed rate offered to them is 5.1%. The new monthly payment calculated on their outstanding balance over the remaining amortization period is $5,180. That is an increase of $1,540 per month on a household that is already running a monthly deficit before any discretionary spending. The Bank of Canada has estimated that households renewing in 2026 will face payment increases averaging approximately 20% above their previous term. For households that entered the renewal period with stable employment and unaffected credit profiles, that 20% increase is painful but manageable with sustained adjustments. For households like James and Patricia, who are simultaneously absorbing a trade shock income reduction, the 20% increase is not survivable without selling the asset or defaulting on the obligation. The decision that James and Patricia now face is the same decision that hundreds of thousands of Canadian households will confront in the months ahead. Do they attempt to hold the mortgage by drawing down every remaining financial resource available, draining the RRSP, maximizing the remaining credit capacity, borrowing from family, taking additional employment, and hoping that James's employer restores full production hours before the available resources are exhausted? Or do they make the financial calculation that a voluntary sale today, while they still control the listing timeline, the asking price, and the closing conditions, produces a measurably better outcome than a power of sale event 6 months from now, when the bank controls every variable. There is no version of this choice that does not involve significant financial loss. The question is whether that loss is bounded and survivable or whether it compounds into a deficiency judgment that follows the family for the next 20 years. A voluntary sale in a declining market still produces a defined outcome. The mortgage is retired. The remaining equity, however reduced, belongs to the family. The credit file records a sale, not a default, and the deficiency judgment risk is eliminated. A power of sale event in a declining market with a bank that is managing its own capital recovery under institutional pressure produces a different category of outcome. The bank prices the asset to move within 30 days. The resulting sale price reflects the speed requirement, not the market value. The deficiency between the sale proceeds and the outstanding mortgage balance becomes a legal judgment against the borrower that survives bankruptcy in certain circumstances and can be enforced against future income and assets for decades. The tariff transmission is not affecting one James and Patricia. It is not a localized event contained within a single manufacturing corridor in southwestern Ontario. The Bank of Canada's sectoral analysis explicitly identifies that the knock-on effects of trade disruption extend well beyond the directly exposed industries. When manufacturing employment falls in Cambridge and Windsor, the service sector businesses that depend on those workers contract in parallel. The regional economic decline that flows from a sustained tariff shock is a multiplier event. One job loss in a trade-exposed sector generates additional job losses in the supporting economy of the same region. The households affected by that multiplier hold mortgages across the income spectrum. They are not all factory workers. They are the contractor who services the factory worker's neighborhood, the healthcare worker whose clinic serves the same community, and the teacher whose school enrollment is contracting as young families leave the region in search of stable employment. They all hold mortgages. They all face renewals in 2025 and 2026. And the trade shock that originated in a Washington policy announcement is now running through every one of their household balance sheets on a timeline they did not choose and cannot delay. What should you do with this analysis? And the answer must be specific to your actual circumstances. If your income is directly connected to a trade-sensitive industry, manufacturing, resource extraction, transportation serving those sectors, or construction dependent on those industries, your renewal timeline is the single most critical variable in your financial life right now. If your renewal falls within the next 18 months, you need to model the new payment today before the letter arrives. Call your lender and request an early renewal quote. Calculate the gap between your current payment and the new payment. Assess honestly whether your current household income at its current level, not the level it was at in 2021, can service that gap. If the honest answer is no, you need to make a voluntary decision while the option to make one still exists. If your income is not directly trade exposed, but your household budget is already absorbing inflation-driven essential cost increases, you are in the indirect transmission channel. The credit utilization signal we documented in the previous investigation applies to your situation with equal force. And the bank's risk model does not distinguish between a manufacturing layoff and an inflation squeeze when it is reading your credit profile. Rising utilization and missed minimum payments produce identical risk flags in the system regardless of their cause. The tariff trap is not a future risk contingent on the outcome of trade negotiations. It is a present condition flowing through the Canadian economy right now in the form of reduced production volumes, lower employment hours, higher essential costs, and a central bank that is explicitly warning about mortgage arrears reaching levels not seen since before most current homeowners purchased their first property. The mechanism is documented. The transmission sequence is understood. And it is operating on a timeline that intersects directly with the renewal wall that over 1 million Canadian households are approaching in 2026. In our next investigation, we are going to examine what happens to the asset after the default event completes. We have now tracked the countdown through every stage from the first credit card signal to the moment the mortgage fails. What we have not yet followed is the money that moves after the power of sale closes. Who acquires the distressed inventory? At what price? Through what legal mechanism? And why the answer to those questions reveals a dimension of the Canadian housing crisis that the mainstream financial press has declared decline to examine with any consistency. Subscribe to Canada Property Watch. But will we translate the financial stability reports that regulators write for institutions into the language that homeowners need before the envelope arrives? The tariff transmission is running. The renewal wall is here. The math does not negotiate and it does not wait.